You're listening to AI Prism from Seoul Economic Daily.
It's Friday, May 8th. I'd like to share some thoughts about global investors. If you're managing a global portfolio right now, you are probably seeing flashing red lights. We are tracking 4 critical macro threads intersecting in Asia today, requiring a real synthesis of cross-asset implications.
Right, because the real value for you here isn't just reading the individual news headlines, right? It's seeing how they all collide.
Exactly. So let's jump straight into the yen, which just broke a 160 to the dollar. Japan finally stepped in, spending roughly 5 trillion yen on a currency intervention.
Yeah, which is about 46.46 trillion won, or roughly 32 billion US dollars.
Right, their first one in nearly 2 years. I mean, to me, it feels like using extremely expensive finite sandbags to hold back a macro ocean.
That is a great analogy. And, well, the bond market read here is what's really crucial. U.S. Treasury Secretary Scott Bessent is visiting Tokyo on May 11th.
Right, for a 3-day visit, right.
Yeah, he's meeting with Prime Minister Takaichi, Finance Minister Katayama from the MOF, and BOJ, or Bank of Japan Governor Ueda.
So wait, why the high-level rush over a currency intervention?
Because of how Japan pays for those sandbags, To defend the yen, Japan might liquidate U.S. treasuries. And if they sell off that debt, U.S. yields spike globally.
Oh, wow.
Exactly. So the quiet question on the table is, can Washington and Tokyo agree to substitute BOJ interest rate hikes instead of those FX-funded treasury sales?
Okay, so we're looking at a severe financial choke point. But if you look across the region, that vulnerability isn't just financial, it's physical.
Specifically Taiwan's energy supply.
Yeah. Because of the blockade in the Strait of Hormuz, Taiwan is down to just 11 days of liquefied natural gas inventory.
Wait, 11 days? That is nothing.
I know. They are basically forced to buy U.S. spot LNG at twice the contract price right now.
Which perfectly explains the back-channel U.S.-Iran negotiations. The Wall Street Journal is reporting an expected 1-month push in Pakistan for a 1-page MOU.
Right, and this MOU is a 12 to 15-year enrichment freeze.
Exactly, paired with a phased restoration of transit through Hormuz.
That's historically huge.
It is. The cross-asset takeaway for you here is that this single negotiation resets Brent crude, the entire global semiconductor complex like TSMC and Amican and Asian risk premia, all at the exact same time.
So speaking of the semiconductor supply chain, that dictates our next major constraint, which is scarce AI compute.
Right, the AI infrastructure reset.
Yeah, so Anthropic just secured 300 megawatts of power and over 220,000 Nvidia GPUs at xAI's Colossus 1 data center.
Which is massive.
Yeah, they're doing this to double the limits on their Claude Code product, and this is happening ahead of a widely reported expected late 2026 IPO. But if even well-capitalized labs are renting from direct rivals, what does that say about infrastructure constraints?
That says we are hitting a structural wall. I mean, look at ServiceNow's CTO, Pat Casey. He recently warned about Mythos, which is an Anthropic model currently in a restricted preview just for selected banks and government.
Right, the restricted one.
Yeah, Casey argued Chinese AI firms could replicate that exact model within 6 months.
Oh, wow. So the closed frontier mode is just gone.
Basically. The institutional read here is that the moat's half-life is shrinking to just quarters. It structurally favors orchestration and physical AI equities now.
Speaking of physical AI and hardware moats, let's look at the ultimate natural experiment in electric vehicles.
Right, South Korea acting as a test market for Chinese autos.
Exactly. So Korea has this EV subsidy structure that relies heavily on local government purchase budgets.
Which are currently draining, right?
Yeah, they are drying up. But even so, China's BYD became the 4th place imported brand there in just 11 months.
Because of the tech and the price. BYD's Celion 6 DMI boasts a 1,670-kilometer plug-in hybrid range.
That's insane, because Hyundai Motor Group, the dominant domestic brands in Korea, Hyundai and Kia, they only build 600 to 700-kilometer PHEVs, and strictly for export.
Right, and it's not just BYD making these incursions. Geely's Zeekr brand is opening a space right on Yeongdong-daero.
Oh, that's the premium auto retail district in Seoul.
Exactly. And they're leveraging a $3 billion US, or about 4.3 trillion won platform shared with Volvo and Polestar. Then you have Chery partnering with Korea's KG Mobility, or KGM.
Oh, right.
And XPeng is launching by late 2026. For U.S. and EU policymakers watching tariff effectiveness, this compounding share gain proves that price and tech are overcoming even the most loyal domestic markets.
Yeah, and that is a massive read for Hyundai and Kia equity and the broader China auto export thesis.
Absolutely. So a final provocative thought for you to mull over. As these geopolitical and physical constraints tighten, consider how quickly these intersecting shifts might force a complete repricing of Asian equity margins by next quarter.
That's today's AI Prism, Global Investors. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI Prism is a One Eye for Ra award-winning series. We'll be back tomorrow.
You've been listening to AI Prism from Seoul Economic Daily.